Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at market performance across the globe over the past 1, 3, 6, and 12 months. We'll have a look at what's happening on the inflation front in Europe. We'll have a look at the best guess of the US labor market at this point. And finally, we'll look at signs that South African economic growth should be upgraded shortly. We're going to start off with global equity performance. The past year has seen some very strong returns across the globe. Global equity is up around 20% in dollars. The past 6 months has seen a very strong return too. 6 months ago was Liberation Day, and because the global economy didn't deteriorate to the extent that was widely expected, and neither did the US, we've seen some very strong returns across the globe. Global equity is up 24% in dollars over the past 6 months, and US equities roughly in line with that. In fact, US equity performance has been roughly in line with the global market over the past 1, 3, 6, and 12 months, despite the Mag 7. It would appear that certainly over the last year, there's been little evidence of US exceptionalism with regards to the equity market. The US market has been performing, say, roughly in line. The standout performer has been Japan, up over 30% over the past 6 months, which has been very good. But the South African equity market has been even better. South African equities up 40% in dollars over the past 6 months. A lot of that is precious metals because of what's happened to gold and platinum. But nonetheless, the South African equity market has had a very strong patch over the past year and 6 months in particular. And that's true in fixed income as well. If you look globally, there's not much of a story with regards to fixed income returns, sort of low single-digit returns, which is what one would expect through the cycle for a lot of developed market fixed income. South African fixed income market has been very strong. South African fixed income returning about 25% in dollars over the past 6 months alone. We were overweight South African fixed income. We've brought that back to neutral. We think the margin of safety in South African fixed income has eroded somewhat. It's now closer to fair value. We still see opportunity in South African equities, though. In currencies, the rand has been quite strong. The dollar's been a bit weak over the past 6 months or so. But I think the real story, again, with regards to SA hasn't necessarily been the rand. It's what's been happening to gold and platinum. And gold has just been incredibly strong, up another 40-odd% over the past year or so. And that's occurred as energy prices have been weak. Switching to Europe, we've seen a slight uptick in inflation in Europe. Inflation coming out at 2.2%, which was in line with the consensus forecast. And with that, we've seen an increase in inflation expectations over the coming year as well. If you look at PPI inflation, which typically is a key leading indicator for CPI inflation, there's little reason for concern there. And the ECB has expressed that there's little reason for concern either, thinking that risks to inflation are balanced on both the upside and the downside. So the increase in inflation in Europe, I don't think is any reason just yet to expect a reversal of course from the ECB. Little reason to expect them to hike rates at any time point. But we are probably past the point at which they cut rates. And ECB cutting has been part of the reason why the European equity market has been as strong as it has been. We mentioned before the strong returns across the globe post-Liberation Day. Europe is an example of that. And what that's done is if you look at the forward PE for the European market, it's now just a bit above the 10-year median. So the valuation argument in Europe, just like we've seen across most of the rest of the globe, has now eroded, but it doesn't mean that the European market is expensive at this point. It's now looking at about fair value. The decline in oil has been very helpful for equities and for consumer demand across the globe. And it's quite interesting that even after the decline in the oil price, we've seen that OPEC Plus is looking to reduce output again, more marginally from November. But should the decline in oil persist, it should take some of the pressure off the Fed and some other central banks and also allow for quite robust consumer spend. Oil is about 3 to 4% of most developed market CPI baskets, so it should allow some of the pressure to come off from inflation perspective. And as mentioned before, while oil has been going down, we've seen a strong rally in gold, and actually we've seen a pretty good rally in other commodities too, most notably copper, which gives an indication of economic activity across the globe being quite strong. So we've had this very beneficial environment where energy prices are down, copper prices are up. That's very helpful for commodity exporting emerging markets and quite helpful for the resources space in general to cut quite aggressively. And that, again, I think is going to be the key debate in the Fed. At the moment, the market is expecting 4 rate cuts over the coming year. And it is interesting that when this GDP number came out, which was so strong, we did see the S&P 500 pull back a bit. under the basis that the Fed would be less likely to cut over the coming year. So I think that expectation in the market of 4 is quite optimistic at this point. Given the data we're seeing, the inflation data, the GDP data, it's likely that the Fed will cut by less than that, which would then be a headwind for US equities. Okay, switching to the US, we'd like to be able to talk about the non-farm payrolls numbers, but we can't because the number didn't come out because of the shutdown in the US. The betting market at this point is currently pricing in the shutdown to persist for another couple of weeks. We do have the CPI print coming out next week, so we might have to try to get some guesstimate work around what the inflation number is. In the meantime, we've done some guesstimate work around what's happened for non-farm payrolls. There are a couple of private sector payroll providers, and we can take an average of them to try and gauge what happened to the jobs market. It's not a perfect estimate. There's some times where there's a sizable divergence between the non-farm payrolls number and the private sector estimate, but it's probably the best guess that we can get at the moment. And if we take an average of the private sector providers, it looks like non-farm payrolls growth last month was about 14,000 jobs, which is quite low and suggests that there's very little sign of job growth in the US. Now, we'll have to wait for the final numbers to confirm that view, but there is some reason for concern around a slowing US economy at this point. And there's other reasons for concern too. If you look, for example, at defaults in private credit, the latest numbers are running around about 8%, which is the highest in at least 6 years, and that's reason for concern as well. And if you look at mortgages, we now see 20% of US citizens with mortgages are now paying over 6% for their mortgages, and 20% have mortgages below 3%. Those numbers are now roughly equivalent. If you go back a couple of years, we had less than 8% of US mortgage holders with mortgages above 6%. So the interest rate story is starting to have an impact. We're seeing some defaults in some parts of the economy, and it looks like weak job growth. So there are reasons for concern with regards to the outlook for US economic activity. In contrast, if you look at the leading indicator in Japan, it's ticked up quite nicely, and there's reasons to believe that Japanese economic activity is likely to start to surprise on the upside. Switching to South Africa, we've had a couple of good data points that came out over the past week or so that reaffirms the notion that we're due some upgrades to South African economic forecasts. An example of this is the PMI data. The South African ABSA BR manufacturing PMI series came out last week. It's at 52. That's close to the top end of the range of what we've seen over the past couple of years or so. This is a series that correlates very strongly with GDP growth. So should the series remain at the current sort of level, we can expect quite sizable upgrades to GDP forecasts. And the series has been quite high over the past 3 months and quite high over the past 6 months too. So there's firm evidence to believe that just due to this series, we're due some upgrades. But even ignoring the series, if you just look at growth in Q1 and Q2, it was sufficiently strong that the South African economy would just need to grow by 0.1% in Q3 and Q4 to get to the 1% for the full year. So given the growth we've already seen, we're due some upgrades because that 0.1% in Q3, Q4 is pretty much a lowball estimate given what we've seen in commodities. So there's good reason to believe that growth will exceed the consensus forecast just given what we've seen. And then you look at the latest data like this PMI series and it suggests again that there should be further upgrades. And so we would expect to see some upgrades from consensus over the coming couple of months or so. The SARB is already upgraded to 1.2%, but even that looks a little light given what we're seeing at the moment. So there's a bit of good news on the South African growth front. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.